Welcome to the daily update, where we'll go over the action in the market for Friday, September 30th, and then see how things look for Monday, October 3rd. And we had another down day, but could it have been worse? The core PCE, the big inflation number that came out, was quite a bit stronger than expected. And based on what I can see here, the markets had every reason to just tank even more than they did, even though it was a down day. We started out positive, but then things developed into a more negative situation as the day went on. So let's go back and talk about what happened. At the open, we did have a lower open, but then we saw some immediate buying coming into the market and it pushed prices higher. We actually went positive. We went above the unchanged level and we went above the daily pivot at 36.45. Then prices topped out under R1. So we never made it up to 36.82 before starting to come back down. As the day went on, selling then took prices back down below the unchanged level. So they went negative and kept falling into the close. So that's pretty negative action overall. We closed at the low for the session. That's usually not a good thing. We're not seeing that pattern of early weakness, late day strength. That certainly didn't happen in Friday's session. But remember, it was the last day of the week, the last day of the month, and the last day of the quarter. So volume did really pick up for the session, but it was a little bit of an anomaly as far as why different volume was taking place than a usual trading day. We did set a new 52-week low with the S&P 500. We were down 1.51% on above average volume. Our technicals are still negative, but we're oversold. We've broken below support, but we haven't massively broken below it. Now we have to figure out, are we going to be able to come back up into this little bit of sideways action, this potential base, or are we going to continue to fall even further from here? It's really hard to determine that right now because we are oversold on the short term, even a few things in the intermediate term and long term as well. So it's like things are looking pretty exhausted to the downside, but we're just not seeing any follow through action to the upside right now. Inflation and interest rates, of course, are the really big concerns, both inside the US domestically as well as foreign. They've got a lot of problems in the UK right now, and things are just not really looking very good. Now, to be warned, sometimes what happens in England, what happens in Europe will precede what happens in the US. Let's hope not, because things are not looking very good in Europe right now, specifically for this upcoming winter. What's going on economically in the EU as well as in the UK? We're having difficult times in the US for sure, but could it even get worse than it is right now? I really hope not, but we have to be realistic at the same time. We have a lot of rumblings going around concerning Russia right now. With the old Nord Stream pipeline, was it sabotage? It looks like it was. Who did it? There's really no answer to that right now, because you could make a case for pretty much any country both to do it or to not do it. And nobody really comes out as a clear candidate for who would do that to the pipeline. We also have earnings that are coming out. It's kind of slowing down a little bit. Currently, the debate going back and forth about a recession and then any Fed speak that may have come out. So, what are some comments that we can make? A lot of the weakness in Friday's session is attributed to concerns with Apple and Nike. Those are two really big companies. And when they go down, the rest of the market tends to go down as well. So I understand with Apple, there's some issues with the production of the iPhone 14. And then Nike's having some earnings warnings that are coming out and they're being downgraded by some of the Wall Street firms. So that really took it into their price. So when these two companies go down, yeah, it's not really good for the market overall. We still have a number of yield curves that are inverted. Sentiment is still tipping down with the down day. We're getting more over to extreme negative, which a lot of times we can use as a contrary indicator, meaning that people are just throwing up their hands saying, okay, I'm out. And a lot of times that can be a bottom. We did have personal income. It came out as expected, 0.3% month over month. That's what they expected. Then personal spending was up pretty much double, and some of that can be attributed to inflation at 0.4% month over month, where they expected it to be up 0.2. So that just shows people are still having to spend money to buy things. And then final consumer sentiment as well. It came in a little bit less than what they expected at 59.5. The last time we got this was at 58.6 is what we got. They expected 59.5, which was the prior reading. So people are just not very happy right now. The Chicago PMI came in underneath 50. So that usually means contraction in the economy, at least in the Chicago area, at 45.7. They expected it to come out at 51.9. Our trend is still negative and we're above 20. The ADX continues to advance. Our bias is negative and our momentum is negative as well. So looking at sentiment, we're starting to tip over and get rather extreme in the fear category, where we're dropping down to other levels that sometimes signal some kind of a bottom. Whether it's going to be substantial or not is yet to be determined. We're also now coming into a more favorable season for the markets. We're starting into October now. And even though we've had big crashes in October, we've also had some pretty solid Octobers. In addition, we have an election coming up too, and sometimes that can promote either pessimism or optimism, depending on your stance on things. We also got another reading this week of active asset managers. Now, remember, this is a week delayed here, but they're really extreme negative, down to 12.61. That is really far extreme right now. We might be able to use that as a contrary indicator to suggest that we might get a bounce. This is the BPI. This is the same chart that I'm going to show you later on. It's also getting down to an extreme negative reading. So we continue to see this convergence of extreme negative indicators, which oftentimes will mark some kind of a bottom in the market. Now, if we do bounce, like what we had on, what was it, Wednesday, is it going to last for more than just one day? Is it just going to work off an oversold condition and then continue to go down? That's why we wait for confirmation from our charts. We try not to buy the dips. That term really just bothers me. It's always bothered me because sometimes it works and sometimes it doesn't, and now you're gambling. I like to have a lot of evidence in front of me before I say, okay, it looks like we've got a bottom here. We're starting to come up out of that. We have a lot of evidence. And so the probabilities are much more in our favor of something continuing to go up instead of, oh, it went down, I think I'll buy some more here. Oh, it went down some more, I'll buy some more. And then people end up dollar cost averaging as something goes lower and lower and lower. But that's just my personal opinion. Most people out there will say, buy the dips, buy the dips. Here's another chart showing US asset classes evaluation as we've looked going all the way back to the mid 80s or so, where treasuries have just bounced all around. That's the gray line, and they've been really falling. We have the S&P 500, that's the black line. And this obviously is a little older here because it has the S&P going up slightly. Property, this is where a lot of people have their wealth, is either in their home or in their land or in a combination of the two. That continues to go up, and it's considered to be rather expensive right now. And then commodities. These are different things like cocoa, sugar, pork bellies, all the things we all have to have. It measures this, and as it has really been going up lately, but these prices are now starting to fall. You're seeing a lot of pressure on commodities right now because of the dollar, because they're traded in dollar denominations. And so when the dollar is going up, that means fewer dollars can buy the same amount of things. Here's another chart showing the current reading of the Ridex bear bull ratio, where we're starting to spike up here. Now, remember, this is a couple days old. This is after Thursday's session. This doesn't take into account Friday's session. So this could still go up a little bit more, since these folks tend to react to what's happening in the market, and we had a down day. So this is starting to get rather extreme currently. We also had the latest reading from individual investors showing that they are still extremely pessimistic on things. They're very bearish, which a lot of times we use this as a contrary indicator as well to suggest that things might bounce from here. What kind of bounce we're going to get, we don't know, but we're seeing a real convergence. This is consumer sentiment showing how it is actually down a little bit from the previous reading at 58.6. And there's a real disconnect between the 2-year treasury yield in red and the blue line here, which is consumer sentiment, where these have a tendency to go in the same direction. And a lot of times they don't get that far apart from each other. Well, there is a really big gap right now, even though it's coming down slightly. The mass index, I only have this because it might be getting close to generating a signal. The first part of this signal is it goes above the blue line, and then when it comes back down over the red line, that's a two-phased signal here. And this is kind of like the Copic curve, where it suggests something could happen, but it doesn't tell us the direction. If you look back in time, sometimes this pointed to the market going up, sometimes it pointed to the market going down, sometimes it gave us a false signal. So we're just keeping an eye on that currently. Here's some Isabel net charts. This is showing the shaded areas on this one are the recessions, where we have the US corporate sector profits on a year-over-year basis, and they're really starting to go down overall. And then you're seeing CEO confidence. That's the black line. I'm sorry, that's the red line. And both are really declining right now, and they're getting pretty extreme as far as CEOs. And they have a tendency to know what's going on in their companies. And if they're getting really pessimistic about things, that, again, we might be able to use this as some kind of contrary indication. Because when everybody's thinking everything is going to get bad, a lot of times that's where we see a turn. This is just showing the S&P monthly seasonality, and we're coming into a positive season right now. This is the second year of a presidential cycle. We also have midterm elections, and so historically, we have seen positive returns during this time. And this chart goes all the way back to 1928. All right, and then the lighter blue line, this just shows the percent of the time that it's been up. Between 60 and 70%, which also means 30 to 40% of the time it goes down. So that's why these are interesting. They're nice to look at. This might help the market a little bit, but we don't want to base everything just on slight probabilities. We want to be a lot more absolute than that. This is gold. It continues to closely track changes in real rates. So these are interest rates taking into account inflation. This light blue line here is the 10-year yield inverted. So actually it's going up, but just to make this chart a little easier to read, they have them going in the same direction, where gold has been going down and interest rates have been going up. So, and they don't have the dollar on here either, and that has been going up as well. That's been really providing a headwind to gold at the same time. This is just showing M2. Now, we used to have a thing called M3, which was a lot broader measure of the markets. And I think it was back in 2005 or so, they just said, well, we're not going to put that information out anymore. And that was just about the time that gold started to take off. We saw the gold ETF come to the market and become very popular. Gold was under $400 at that point. And ever since then, that's when gold really started to shoot up. And the biggest measure that we have right now is a thing called M2, and this just measures the amount of money that's in the US economy. And where it really spiked up during the whole COVID lockdowns and when they were spilling all this money into the market, it's really been dropping off. Now, that could help the dollar a little bit. There's fear. If there are fewer dollars out there, that means they're more precious, so their value tends to hold up a little bit. It also means that there is fewer dollars out there, which may make things a little more difficult to buy as well. This is the 60/40 equity bond portfolio. This is what a lot of folks do. They take 100% of their money, they take 60% of that and put it into stocks, and then 40% into bonds. And it just shows, how did this perform over the last 12 months? Well, within the US, it's been pretty bad. And in Europe, it's been pretty bad. And even though Japan is having a lot of problems, they haven't been tanking as much as the US and Europe has been, at least in 2022. But this is really nothing to be envious about, because they've got their own problems in Japan that once they come to the head, if they come to head at some point, what we've been hearing out of the UK and the EU and even in the US, it's going to make what we're dealing with now look kind of good, because what's potentially happening in Japan could have some real devastating effects. All right, let's go back and look at the session where the growth was down more than value with the large caps. They were down a little bit less with the mid caps and the small caps. And we've been seeing this over the last few days, where even with down days, growth has been, now we would consider this outperforming since it was down less. We've been seeing a little bit of an improvement with the small caps and the mid caps, even with the downward movement. That could potentially be positive and give some support to the large caps. With the down day, we actually saw the VIX close a little, just a tick lower, and it came down as the market was going up and then shot up as the market was going down, and we closed right in about the middle of this bar. Here's the VIX of the VIX, which shows it slowing down slightly. And then we're just watching this for right now, where we had the RSI on the VIX. It shot up to give us an extreme reading, and it's come back down. It's still going down, but with the down days, and if the VIX really starts to go back up, we would expect to see the RSI go back up. Or we could, if we end up getting a bounce from here, we could say this was the signal. It was just a few days early, and now the VIX might end up starting to come down as stocks go up. Just one thing to think about. The Ulcer Index is also starting to come down. This measures fear, and I'm showing a longer term look here, just so you have more of a historical reference, where we're starting to come down with that. We're down 25.59%. Yeah, looked like we were doing better here for a while, but not right now. And you see we closed right at the bottom of the bar in Friday's session. So that is not positive. The equity put call ratio actually declined on the daily chart, and we're starting to come down after hitting a pretty extreme reading with the 5-period equity put call ratio. And at the end, I have a longer version of this chart to show you that this might end up being one of our possible positive scenarios. Support and resistance for Monday's session is listed right here over on the far right-hand side. Here's the daily chart where we broke down, set a new low for the year. We broke down below support. Is this going to be something that leads to more downside from here? Are we going to go sideways for a little while because we're so oversold? Or are we going to be able to get back above this support level and actually go higher? And then down at the bottom, you see where there was a real increase in volume. Here are the pivot levels that are readjusting now for October. The fib levels, just showing how we've broken below, which had been a base that was building up right here. We've now dropped below that. And we're kind of in no man's land with our longer term fib chart, where the next level on this chart is 50% retracement at 3509 or 3510, right around in that area. The weekly chart, we're coming right down to this 200, this very long 200-week moving average. That is major support. It's not necessarily a surprise that we stopped right at this level. That was the low that we set. Can we get some bounce up off of that? If we fall through that, that could be quite negative, and then we'd fall down probably to this 50% retracement level at 3507. We're coming down a little bit to the bottom side of the midpoint of our trend channel. That is also negative, but doesn't necessarily mean the end of the world currently. Looking at our sectors, 10 out of the 11 were negative, led lower by discretionary, utilities, and tech, as well as staples. Well, all these. It was just an ugly day. Real estate was up slightly, up over 1% as a sector. We have one sector that is currently above 90. That's the energy sector. All of the other charts are below 90, and we still have communication picking up the rear at 6.5. We're seeing a lot of pretty much across the board weakness right now, where energy's been giving back some, even though they're still up. Utilities, which had been positive, have now turned negative as a sector, and then all the other sectors that are still negative. Here's an updated look at the percentage changes since the S&P hit its all-time high back in January. Technical alerts, there was only one that was positive, and that was early in the day when the NASDAQ went above 10,008. First, it went to 10,007, and then it went to 10,006. That's about as low as it went. The S&P set another 52-week low. We crossed below 3,600. Oil went below 80, which again could be seen as positive, but we're still seeing new 52-week lows as we break through this support level. And things are just not positive right now, but we're starting to get more extreme. The mid caps are currently looking the best at 51.3, which is not a good score, followed by the Dow at 50.5. The small caps are at 44.7. In fourth place is the S&P. It's really showing some recent weakness since we set a new low, and the Qs are doing really bad now at 17.1. Intraday, so we gapped lower, and we could have gapped a lot lower than this with that stronger than expected core PCE report that came out. I was looking for, when I saw the report, I was waiting for the futures to drop a lot more than they did, which it might be saying something. When the market stops reacting as much to negative news, a lot of times that can signal that, okay, people are just tired of everything being negative all the time. Let's see if this market has a chance of going up. Now, I'm not saying that's what's happening, but it just seems like we've had bad news after bad news after bad news, and the market's been dropping. We got some more, which could have been taken as bad news. And yeah, we dropped, but we also had a pretty solid initial reaction that was positive. But we never did come down to S1 at the open. We came back above the unchanged level, above the pivot. We topped out well below R1, came back down, went negative again, and then closed right down here at the low for the session, right on that 200-week moving average. Looking at our trend, the ADX continues to go up with the red line on top, so it is negative and getting stronger. The Arun is still looking pretty extreme negative right now. The red line's on top, that's negative. The green line is declining, that's also negative. That means buyers are going away. When you compare the two, it's not looking good overall. Breadth is just showing a follow through of weakness, both based on price and volume. The advanced decline ratio also starting to get extreme negative again. New highs, new lows. Even though they're trying to turn up just a little bit here, we're still seeing less of a advance in new lows, but still we want to see green up here for things to turn positive instead of just less red. And then the 10-day differential continues to decline. Accumulation distribution is also showing weakness. Short term, this is where we're getting back to more of an oversold condition or just a continuation of the oversold condition. Our rate of change going back 10 periods is extreme negative. The Stoke RSI, extreme negative. Williams percent R, extreme negative. Force index, not quite down to the Keltner band, but still quite negative. This is a little bit positive. We have the Swinland Trading Oscillator, which sometimes is a leading indicator for us. Unfortunately, it's also led us astray at times, and we don't really know at the time if this is going to be legitimate or not, but it actually went up after being extreme negative based on price and volume. So possibly with the convergence of all these other contrarian indicators and that we're so oversold, maybe this is telling us that we might get some kind of a bounce. Now, we've been at this place before with this indicator only to have it give us a bad signal. So be aware of that. McClellan Oscillator is extreme negative, and we're extreme negative with our 20, 50, and 200-day moving average study. All of our stochastics continue to be extreme negative. Intermediate term, we're still extreme with our 19-day exponential moving average. This oftentimes when it spikes down like this, sometimes sets a low in the S&P. So that's one area, both based on price and volume. Standard deviation coming back down a little bit as prices slowed down slightly. Rate of change 20 periods, looking extreme negative. Sean trend meter, also extreme negative. The PMO, all of our oscillators are still negative. They're declining overall. Those that are rising, the buy signals, and those that are above zero continue to be extreme negative. Chaikin oscillator, also negative and not necessarily extreme. Chaikin money flow, also showing some weakness. Volume did pick up because of the end of the week, month, and quarter. We saw some rebalancing going on there. The vortex continues to be negative with the red line on top. Summation index based on price is declining and kind of getting rather extreme, and we've already gone extreme based on volume. All of our oscillators, as I said, continue to be negative. The bullish percent index also starting to get extreme negative. Now, we tried to bounce up with that one up day that we had, only to come right back down. Ease of movement also continues to decline. Ultimate oscillator is declining. Money flow, and we don't get a lot of signals from this, it's starting to get extreme negative. CCI 14, just right on the verge of being extreme negative, as is the 20 period. RSI coming back down to extreme, both with the 14 and the 9 period studies. Boom indicator also extreme negative when compared to the 50-day moving average, and declining and getting further down to an extreme reading based on the 200-day moving average. We're finally starting to see utilities catch up. See how they're coming back down to the low that was set here, where transports had already set new lows and the Dow had already set new lows. So this is not necessarily good because the utilities had been holding up a lot better, but they've been seeing some real weakness as of late. But that could be good for the S&P for our ratio chart that I'll show you later. The TTM squeeze continues to be negative. Balance of power is negative, and we're back down to this area where we could be getting rather extreme with this indicator. We're not quite seeing a cross of the green line here. This is technically a signal right now, but we're rolling over currently. When we get a signal, it's when we cross the first line, and then a confirmation is when it crosses the second line. Well, I would be real suspicious of this signal. Our different charts that just measure the trend were negative with the Heikin Ashi, going down with the Kegi charts. The Renko chart is negative. 3-line break is negative. We put in a new zero after having a triple bottom breakdown with the point and figure chart. That's negative. The Elder Impulse is negative for the S&P and the SPY. The SAR system continues to be negative with the dots on top. We're still very deep purple with the go, no-go system. That's negative. And we're looking really extended with our 50, 150, and 200-day moving average studies. Rate of change going back 200 periods, which is roughly a year. We're getting back down here into the COVID areas of the COVID low. Special K continues to decline, and it's actually starting to come down to this line, which could be extreme negative. We have the diamonds, which is the Dow, that switched over to negative. Here's the Dow just also making a new 52-week low. The Qs are also negative and making a new 52-week low. The Vixen didn't really go up all that much. It actually went down slightly on a closing basis, and the bar was not all that heavy. NASDAQ also setting, it's not quite at a 52-week low, but we're getting really close. We might want to look at this as a possible support level right now to see if this gets tested, and maybe we get some support from the NASDAQ or the NASDAQ 100, because that's what's really going to help this market go back up, is the tech stocks or the growth stocks, which are in the NASDAQ mainly. The mid caps, they didn't really fall down as much, but the small cap or the Wilshire did. It actually came down and set a new 52-week low. And I don't know why this is is going so slow here. The dollar was down slightly, but we're still in a pretty solid uptrend. The British pound, after really tanking, has been trying to recoup some of the losses. The S&P to the dollar still pretty strongly inversely correlated. So if the dollar is going up or down, the S&P is tending to do the opposite. Gold virtually unchanged. It tried to break out, but then came back down. Silver was up 0.75%, came right up to the 50-day moving average before coming back down, and is still in an overall downtrend. Oil broke down below 80 again to 79.49. And the correlation between S&P and the oil still pretty strong, where they're both having the tendency to go either up or down together. Here's the intermarket analysis chart showing how oil is coming back down. The dollar is the next in line, followed by gold, stocks, and bonds, which are all negative going back to the beginning of the year. I haven't brought this up in a while. This is Bitcoin. It's still floundering, right? A little above, a little below 20,000, and has been there for quite a while, because this is another Isabel net chart. And right now, we're just seeing a real lack of inflows into Bitcoin right now. It's not moving all over the place. People aren't rah-ing it right now. So there's less money going into it. Plus, with the big move up and then down, a lot of people lost a lot of money doing that. Looking at bonds, we continue to show overall weakness with the bond ETF and with the world bond index, even though we're slightly up off of the lows. The 10-year treasury yield, which spiked up, actually came down slightly. The 30-year yield also declined slightly in Friday's session. Stocks and bonds are still having a real tendency to go in the same direction, and that tends to be down right now. Our yield curves, nothing has changed here. The 10 to the 5, the 10 to the 2, those are inverted. The 30 to the 5 is inverted, and the 10-year to the 3-month remains not inverted or normal right now. Tech sector to the 10-year also having a tendency to go in opposite directions. Here are yields, which went back up in Friday's session, except for the 3-month, the short-term maturity, it actually declined. Our scenarios, we're starting to get to the point where new signals are being generated. Here with the 200-day simple moving average, we're getting down to this extreme negative reading. It would be even more powerful if we could drop down a little bit more, but this also has been a pretty good time in the past where this provided some support to the S&P. Then looking at a shorter term moving average, the 50 period, we're still extreme with the S&P, with the mid caps and the small caps. So again, we're seeing this real convergence. If a bounce is going to happen, things are lining up for that to happen, but we have to see follow through with price and more than just one day. Here's the 10-day average of the highs minus the lows. This is also giving us a really extreme reading right now, and this often marks a bottom in the S&P. The 5-period moving average of the highs minus the lows, also down here to this extreme area, often marks a bottom. Here's where we spiked up with the equity put call ratio. This is the longer term version of the chart. We came up and now we're starting to come back down. This also has in the past marked a bottom. The small caps pretty much going sideways, similar to the mid caps. We're seeing a lot of the weakness right now in the large caps and in the NASDAQ stocks. Where the small caps are coming up, they outperform just a little bit compared to the S&P, but we're not really going up and spiking yet on this red chart. So that's really not giving any support to the blue chart, which is the S&P. Here's the S&P to the 10-year, also going in opposite directions. Here's our sector rotation, rolling over with the Qs, rolling over with discretionary, rolling over with large cap growth against value, rolling over again here with the large cap growth in value. But look at the mid caps and the small caps. We are seeing some improvement here. That could give the market some hope if we see follow through. The S&P to the 2-year yield also going in opposite directions, but it continues to just spike up currently, which a lot of times in the past when this has spiked, this has provided either intermediate to short-term support for the S&P. We're also seeing a bit of an improvement with the ratio between the S&P and the utilities. It is starting to go back up. And if you look at times where we bottomed and went back up, that often gave some support to the S&P 500. The staples have really been having some problems now. We're still in the area of this spike, but we did see a decline in Friday's session when we measure the ratio. So what's our outlook then for Monday? The technicals are that we're negative and oversold, which is kind of the same story that I gave in yesterday's video. It was the last trading day of the week, month, and the quarter. I should have taken that out actually, because it'll be the first trading day on Monday. We do have the final IHS market manufacturing PMI coming out, and the ISM. This is a big one. The ISM manufacturing index, that'll be coming out in Monday's session. We'll also get construction spending, and then the whole list of all the crazy things that are going on, and our list seems to be just getting longer. The big fixation now is inflation and interest rates as it applies to the market. We have a hurricane that we're dealing with. We have an election that's coming up. There's a lot of things going on in the UK. There's all these debates going back and forth. What I'm focusing on right now, and the Mariners made it to the playoffs. That's kind of a cool thing. I'm a big Seattle Mariners fan because I'm from Seattle. But the markets are really fixated right now on the inflation and interest rate concerns. So our scenarios, hard to go with the down scenario because we're oversold. Hard to go with the up scenario because everything is still pointed down, and hard to go with the sideways strategy right now or view of the market because the ADX is going up. It's above 20 and it is negative. So our conclusion, we are negative but oversold pretty much on every time frame right now. So thank you. Have a wonderful weekend. And I will prepare the weekly video and post that, as well as the intermarket analysis video. And I'll have both of those posted before the opening on Monday for the session.